You're listening to the Valley Current.
Usually when we talk about the stock market, there is this this expectation of, well, gravity.
Right.
Like actual physics. A company makes a product, they sell the product, earn a profit, and the stock price kind of just reflects that reality.
Yeah, we like things to be tethered to traditional valuation metrics.
Exactly.
Revenue in, earnings out, very grounded.
But then you step into the world of orbital infrastructure and artificial intelligence, and suddenly that financial gravity just entirely ceases to exist.
It really does.
We are looking at a market landscape today that is completely untethered. So welcome to today's deep dive. For context, it is Thursday, May 21, 2026, and yesterday, the tech and financial worlds effectively tilted on their axis.
That is not an understatement.
No, because SpaceX publicly filed to go public. We're looking at what is aiming to be the largest initial public offering in the history of capital markets.
And to make sense of this, we're relying today on a definitive analysis by the Computer Law Group, or CLG LLP. It was written by their managing partner, Jack Russo.
Right, and our mission today, for you listening, is to look way beyond the hype. We need to unpack this absolute behemoth of a filing. I mean, it's a 200,000-word S1 document.
Which is massive.
Yeah, it's basically the foundational paperwork a company has to give the SEC to let investors look under the hood before going public. So we're going to explore the unprecedented governance structure they've set up, a massive and frankly secret AI deal that was just revealed, and whether historical bubble cycles tell us this stock is going to bless its investors or completely curse them.
What's fascinating here is that this isn't just an IPO.
Right.
It is really the capstone of this entire AI cycle we've been living through. And on the legal side, it's the ultimate test of a brand new corporate legal framework based not in Delaware, where we usually see this stuff, but in Texas.
Okay, let's unpack this raw data because the numbers are just staggering. The ticker is going to be SPCX, and they are doing a dual listing on both the NASDAQ and a newly operational NASDAQ Texas venue. They are targeting a capital raise between $75 and $80 billion.
Which is just...
It puts the total company valuation at an unbelievable $1.75 to $2 trillion.
And just to put that in perspective for you, the sheer scale of that raise is something we have literally never seen in modern financial history.
I mean, I need a baseline here to even process that.
Yeah.
Because the previous record holders for IPOs were what? Saudi Aramco in 2019, which raised about $25.6 billion.
Right.
And Alibaba back in 2014, raising $21.7 billion. This SpaceX target is 3 times the size of the largest IPO in history.
Yeah.
How can a single company, in a single offering, absorb this much capital all at once? Especially because the filing reveals a 30% retail allocation spread across consumer brokers.
Right.
Like Robinhood, SoFi, Charles Schwab, and Fidelity.
Which is incredibly high.
A normal retail allocation is like, what, 10%?
Casually, yeah.
So are regular people really going to buy up that much stock?
That is exactly the trillion-dollar question.
Yeah.
Because that massive retail army is a textbook marker of what financial historians call euphoria. Right. There's a 23-bank syndicate underwriting this, and it's led by Goldman Sachs. They're the ones actually orchestrating the sale of these shares to the public. And they are relying heavily on that retail enthusiasm.
Right.
But more importantly, they are relying on forced index fund demand.
Wait, unpack that for me. Forced demand.
Exactly. So when a company this huge goes public and gets added to major indices like the S&P 500 or the NASDAQ 100, mutual funds and ETFs that track those market averages are mathematically forced to buy the stock.
Oh, wow.
They don't get to look at the fundamentals and say, this seems overvalued.
Right, they have to buy it.
Their entire mandate is to mirror the index. So if SpaceX is suddenly 3% of the index, the fund has to allocate 3% of its capital to SpaceX just to keep its portfolio accurate.
That is wild.
It creates this automatic tsunami of cash, regardless of the company's actual financial health.
It's like a guaranteed buyer at almost any price. And the math on this makes the mind spin. Because at a $2 trillion valuation, the CEO, Elon Musk, becomes the world's first trillionaire.
Yeah.
His on-paper stake, based on his holdings, would sit somewhere between $700 and $900 billion.
It is a level of wealth concentration that is entirely unprecedented in modern capital markets.
Which naturally leads us to the next massive question for you listening. If one guy is worth nearly $1 trillion on paper, how is the company actually governed?
Right.
How does one man wield $1 trillion public entity? Because to understand that, you really have to look at the legal maneuvering that happened before this IPO was even filed.
The doctrinal half of this story is what Jack Russo calls the Texas architecture.
We have to talk about the Texas Dexit.
Yes.
Because the filing shows that SpaceX reincorporated from Delaware to Texas back in February 2024. And that wasn't random at all.
Not at all.
It happened exactly 15 days after a judge in Delaware voided Musk's massive $55 billion pay package at Tesla in a case called Tornetta. Now, that decision was later reversed, but by then, the migration to Texas was already structural.
Yeah.
Texas literally passed legislation to formalize the corporate protections that Delaware had wavered on.
Right. Texas codified something called the business judgment rule and set up a brand new Texas business court to handle corporate disputes. For you listening, the business judgment rule is essentially a legal doctrine that says courts will not second-guess the decisions of a company's management or board.
As long as there's no blatant fraud.
Exactly. No fraud or explicit conflict of interest. Delaware has this too, but Texas made it much more bulletproof for founders.
Wow.
And SpaceX's paperwork uses every single feature of this new Texas law to build an absolute fortress around its CEO.
It's an impenetrable fortress. I mean, under this dual-class structure they've set up, Class A shares, which is what you or I would buy, get 1 vote.
Right.
But Class B shares get 10 votes. And Musk holds 93.6% of those Class B supervoting shares, which gives him 85.1% of the total voting power of the entire public company.
It's extraordinary.
It feels like playing a board game where one player legally owns the rule book, wrote all the rules, and mathematically cannot be voted off the table.
Yeah, he is the CEO, CTO, and chairman.
And according to the rules they've filed, he can only be removed by a majority vote of the Class B shares, meaning he literally cannot be fired unless he votes to fire himself.
This raises an important question, though, for the institutional investors who usually buy into these offerings. What happens to fiduciary responsibility?
Right.
Because it gets even more extreme. The paperwork contains a corporate opportunity waiver.
What does it actually mean in plain English?
It explicitly allows Musk to pursue businesses that compete directly with SpaceX.
Wait, really?
Yeah. Usually if you're the CEO of a company, you can't go start a side hustle in your garage that directly competes with your main company.
You know, you'd get sued.
You'd get sued by your shareholders for stealing corporate opportunities. But this waiver explicitly says he can do that. On top of that, they are relying on a controlled company exemption to avoid having a majority independent board of directors.
Which has definitely not gone unnoticed.
Yeah.
I mean, we are seeing massive institutional pushback on this. The source notes a joint letter from the New York City Comptroller, the New York State Comptroller, and the CEO of CalPERS.
Yeah, the pension funds.
Right. These people oversee about $1 trillion in public pension assets. And they publicly condemned this. They called it the, quote, most management favorable governance structure ever brought to U.S. public markets at this scale.
And they're pointing out that this structure eliminates all the traditional levers of accountability that protect the retirements of millions of public servants.
Right, because standard corporate governance relies on independent boards and the ability to replace underperforming management.
This structure removes those safety nets entirely.
But the wildest detail of this governance structure has to be the compensation plan. Bloomberg called it the Marshot pay package.
This part is unbelievable.
Musk has a new grant of 1 billion performance-based restricted shares. But they don't just vest over time like a normal tech job. They vest in 15 increments, all the way up to a $7.5 trillion market cap.
Yep.
And this is the kicker. The final tranches require the establishment of, quote, a permanent human colony on Mars with at least 1 million inhabitants.
It's a legally binding corporate milestone tied to planetary colonization.
I mean, that is just incredible to even read in an SEC document. But look, governance alone doesn't get you a $2 trillion valuation.
No, it doesn't.
You don't get valued at $2 trillion just because you're hard to fire, especially when you look at the financials.
Right, the numbers.
The financial breakdown in the filing shows SpaceX had $18.6 billion in revenue in 2025, which is great, but they reported a $4.94 billion net loss.
Yeah.
They have an accumulated deficit of $41.3 billion.
It's massive.
So Musk has built a legal fortress where he can't be fired, but investors usually only tolerate that kind of dictatorial control if the company's print of money, and SpaceX isn't. Which forces us to ask, why are investors valuing a money-losing company at $2 trillion?
Exactly.
To understand this 100x revenue multiple, you have to look at their secret economic engine.
And the filing reveals something the market has only speculated about until now.
Here's where it gets really interesting. Hidden in the disclosures is an absolute bombshell. Anthropic, the company that makes the Claude AI model, has committed to paying SpaceX $1.25 billion per month.
Per month.
That is $15 billion a year and up to $45 billion cumulatively by 2029.
It's a staggering figure.
And what are they buying? They are leasing access to 220,000 NVIDIA GPUs at a SpaceX supercomputer called Colossus 1 down in Memphis.
It is arguably the single most consequential fact in the entire 200,000-word document.
But wait, I have to push back here because how does this make any sense?
Okay.
Anthropic is a direct competitor to Elon Musk's own AI company, XAI, and their model, Grok. Why on earth would SpaceX, a rocket company, lease the ultimate computational superpower to a direct rival?
It's a great question.
Are they just becoming a utility company? I mean, the source mentions analysts calling them the core weave of space or data centers in the sky. Is SpaceX secretly just an AI landlord?
It's the ultimate competitive irony, really. But it synthesizes two distinct possibilities for you as an observer trying to figure out how this market works.
Okay.
First, it completely validates the idea that SpaceX has built a massive, undeniable structural advantage in AI compute infrastructure.
Like they figured out the hardware side better than anyone.
Right. Because training these frontier AI models requires absurd amounts of power, cooling, and specialized networking.
Yeah.
SpaceX apparently cracked that code in Memphis. They have the physical power, they have the GPUs, and they have the facility. Or second, it shows something fundamental about the economics of the AI race right now.
Which is what?
That the largest buyers of compute are simply forced to subsidize the largest providers, no matter the rivalries, because the infrastructure is so scarce and incredibly expensive to build.
Wow. So Anthropic literally has no choice but to write $1 billion check every single month to their rival's parent company just to stay in the game.
Exactly. And we shouldn't lose sight of the company's physical, real-world moat, which is staggering on its own. While the AI compute side is flashy, SpaceX delivered 84% of all global orbital upmass in 2024.
Just to clarify for everyone, upmass is the actual physical weight of satellites and cargo being successfully launched into space, right?
Correct. They are essentially a monopoly on Earth-to-orbit logistics.
Yeah.
They operate over 10,000 Starlink satellites, and Starlink is the actual cash engine here. It generated $11.4 billion of the revenue in 2025 and turned a $4.4 billion operating profit.
Wow. So the connectivity segment is basically carrying the financial load for the rest of the company's ambition.
Which they desperately need because the internal XAI segment lost $6.4 billion.
Right. But there's also an incredible web of related party transactions disclosed here that shows just how deeply intertwined all of these companies are.
Oh, yeah, it's a tangled web.
In 2025, SpaceX spent $131 million purchasing Cybertrucks from Tesla at full retail price.
Which is just wild to think about.
That accounted for 18% of all U.S. Cybertruck registrations in the fourth quarter alone. Without SpaceX buying them, Tesla's Q4 registrations for that vehicle would have fallen 51% year over year.
It highlights a highly unusual level of financial interconnectivity between Musk's various enterprises.
Right, and SpaceX also paid $885 million in 2025 to affiliated counterparties for compute and equipment, including funds tied to SpaceX board members.
It's all staying very much in the family.
Yeah. And beyond the financials, there are tragic, real-world risks disclosed in that 38-page risk factor section.
Right.
The document notes an OSHA investigation following a May 15, 2026 fatality at Starbase, where a 25-year-old contractor fell from scaffolding. The physical reality of building rockets is inherently dangerous and heavily regulated across the FAA, FCC, EPA, and OSHA.
So when you look at all of this together...
Yeah, let's step back for a second and look at the whole board. We have a company losing almost $5 billion a year. We have an undeniable retail euphoria with a 30% allocation. We have a CEO who holds 85% of the vote and legally cannot be fired.
Right.
And a valuation that is 100 times their revenue. So what does this all mean? Have we seen this movie before? Because it feels incredibly precarious.
If we connect this to the bigger picture, Jack Russo's analysis introduces some brilliant historical frameworks to help us understand this specific moment.
Okay.
He uses the economic theories of four major thinkers: Schumpeter, Minsky, Kindleberger, and Perez. And these are crucial for you to understand if you want to make sense of this IPO.
Why is that?
Because they explain exactly how these cycles work. Let's start with Hyman Minsky's financial instability hypothesis. Minsky categorizes finance into 3 stages: hedge, speculative, and Ponzi finance.
Okay, let's unpack those. Ponzi finance obviously doesn't sound very good.
It's the most dangerous stage. In hedge finance, your cash flows cover your debts.
Makes sense.
In speculative, you can pay the interest, but you have to roll over the principal. But in Ponzi finance, the cash flow covers neither the principal nor the interest. The structure only survives if asset prices keep going up, so you can constantly refinance or raise new cash.
Wow.
When you look at the XAI segment of SpaceX, which lost $6.4 billion in 2025, it cannot survive on its own.
No.
It requires the profits from Starlink, it requires that $15 billion check from Anthropic, and crucially, it requires this massive influx of public stock market cash from the IPO.
So if any one of those 3 legs breaks, say Anthropic exercises its 90-day termination right on that lease, the financial structure becomes fundamentally unstable.
Exactly.
It's walking a tightrope.
Yeah.
It only works if everyone keeps believing it works and keeps pumping money into it.
Precisely. Next, you have Charles Kindleberger's framework on financial panics. He outlines a 5-stage cycle ending in euphoria and then panic.
And we are definitely in euphoria.
A $2 trillion valuation on a loss-making issuer, driven by a celebrity CEO and a massive retail hype machine, is a textbook marker of the late-stage euphoria phase. By Kindleberger's criteria, this massive retail participation is the defining signal that the AI and space boom has reached peak mania.
And what happens after peak mania? Because the source draws one comparison here that I found absolutely chilling, but also incredibly fascinating.
The RCA parallel.
Yes, the 1929 Radio Corporation of America, or RCA.
This is perhaps the most vital parallel for you to grasp. In the 1920s, RCA was the dominant player in radio, which was the transformative network technology of its time, much like AI and satellite internet today.
Right.
RCA's stock price went from about $5.80 in 1921 to over $114 in September 1929. Everyone was buying it on margin.
Just massive hype.
And then the crash. Between September 1929 and May 1932, RCA stock dropped 98%.
98%. That is a total wipeout.
A complete wipeout for the equity holders. But here is the critical part. Radio wasn't a fraud.
No, it was real.
RCA wasn't a fake company. Radio went on to change the world for the next 50 years. The technology endured and changed society, but the equity, the stock itself, did not survive the cycle because it was mispriced relative to the actual cash it could generate at the time.
It's the classic difference between investing in the physical railroad tracks versus the railroad stock.
Exactly.
The people who bought the railroad stock at the peak of the mania lost everything, but the tracks stayed in the ground.
Right.
The trains still ran. The economy became permanently more efficient. It feels like Russo is arguing that Starlink, the Falcon rockets, the Memphis AI supercomputers, that physical infrastructure is going to survive and define the next decade, even if the $2 trillion equity valuation crashes back to Earth.
And that perfectly aligns with Carlota Perez's technological revolution framework.
Okay, what did she say?
She argues that in the frenzy phase of a technological boom, financial capital completely decouples from fundamental value, and infrastructure gets massively overbuilt.
Because everyone's throwing money at it.
Exactly. Investors throw billions at the wall. But that overbuild is exactly what creates the cheap surplus capacity that powers the next phase of society. The infrastructure survives the equity wipeout.
So to summarize the core tension for you listening today, SpaceX is simultaneously the most technologically defensible IPO of this entire cycle. I mean, they literally have the deepest moat in capital markets with 84% of all mass launched into orbit.
Right.
But they're also the most indefensible on governance and valuation grounds. It is a total paradox.
And that is the crucial takeaway for you, whether you're evaluating this for your own portfolio or just trying to understand the history of technology as it happens.
Yeah.
When you're looking at a hype cycle of this magnitude, the key isn't just asking, is a crash coming? The much more important question is identifying which physical assets, which satellites, which launch pads, which GPU clusters will actually survive the financial frenzy and keep operating when the dust settles.
It really brings us back to that idea of gravity we started with.
It does.
The stock market might be untethered right now, floating in this $2 trillion zero-gravity euphoria. But the physical rockets and the servers are bolted to the ground.
They are very much bound by the laws of physics and eventually the laws of economics.
Which leaves us with one final, very provocative thought to mull over. We talked earlier about how Musk's trillion-dollar compensation package is legally tied to putting 1 million humans on Mars.
Right, the Mars shot.
But under Texas law, corporate directors have a fiduciary duty to act in the best financial interests of the corporation and its shareholders right here on Earth.
Yep.
So what happens in 10 years when the fiduciary duty to generate profits for shareholders on Earth directly conflicts with the massive financial incentive to conquer an entirely different planet?
It's going to be fascinating.
When the rules of the corporate board game collide with the reality of the solar system, which gravity pulls hardest?
A $1 trillion question indeed.
Thanks for joining us on this deep dive. We'll see you next time.
Tune in next time on The Valley Current.